As president of Bluespring Wealth Partners, David is focused on positioning the organization as one of the premier acquirers in the industry. This includes overseeing day-to-day operations and identifying new areas of opportunity and growth for Bluespring Wealth Partners. In his previous role as executive vice president and head of the RA segment for Fidelity Clearing and Custody Solutions, he led a team that provided a comprehensive custody platform, brokerage service, trading capabilities, and practice management and consulting services to registered investment advisors. During his career, David has held numerous positions as well-respected financial institutions, gaining experience in multiple facets of the industry. He was head legal counsel at Schwab Institutional, chief legal and compliance officer at Post Advisory Group, and other roles focused on practice management, trading and operations, consulting, and investments, making David a well-rounded leader in the RA space. He currently sits on a couple of charitable boards. Listen, David and I have a similar background up until a point in that he's an attorney and he's in the RA industry, but then we quickly diverged after that as he moved over to the business side and has done pretty much everything you can do in the industry and has made a significant jump from the custody side over to what is becoming one of the real premier and competitive aggregators in the space. So I'm so excited to have David on the podcast. David, welcome.
Corey, thank you. It's a pleasure to be here. Grateful to get the chance to be on your up and coming and expanding listener and viewership. So thank you for having us.
Yeah. I mean, like we were talking to the pre-call, it's amazing where this thing has gone from where it started. But any case, so David, before we get into what you're doing now and the unique thing that you guys have in the marketplace and what you offer for potential RAs and advisors who want to sell, I want to take you back to when you were a little kid growing up, maybe 8, 10, 12 years old. What did you want to be? Because my guess is running an aggregator firm in the RA space or being in the custody in the RA space or anything related to the RA space probably wasn't it at that age, but you tell me.
Well, I mean, it's actually an easy answer. I actually wanted to be in entertainment. And actually, so much of what we do is in entertainment and communications. I mean, as we were in our prep here, Corey, I was telling you about how I love to play guitar and music. Yep. And actually, believe it or not, I did train part of my career to be an actor. I just couldn't get any work. I was an extra. But then I quickly found other career outlets, including I was drawn to law because I really enjoyed the opportunity to do trial work. And believe it or not, I was in the courtroom a long time ago. Some of the most interesting experiences in my career were doing civil cases, which we could talk about here or some other time.
I love it. See, and that's definitely where we diverge because I avoid the courtroom like a plague. I've been a deal guy since the early days, and I'm like, I want to put stuff together. I don't want to fight with people in court. Although I will tell you, when I left big firm practice and was 30 years old and hung out my own shingle, I did do a little bit of everything for about a year before I could rein it back into the corporate work. And I did find myself in a couple of courtrooms trying to figure out, do I wave to the judge? What am I supposed to do? So,
well, being in the courtroom can be fun, provided that you're not a defendant.
Yeah, there you go. Right. Exactly. All right. One other question looking back. What is the first deal of any type you could think of doing? It could be something little when you were a kid or early in your career, whatever comes to mind, the first, anything that was a deal.
Oh, I mean, I can go way back, but probably the most interesting deal that I was a part of, because it was fun to watch the evolution. And I only played a minor part, was one of our clients in California actually owned the land in Half Moon Bay that where the Ritz-Carlton Half Moon Bay sits. So if you ever been to that hotel, that was a seemingly undevelopable piece of land. And there were so many regulations that had to be satisfied, all for good cause. The California Coastal Commission, the US EPA, the Army Corps of Engineers, Endangered Species Act, and just sort of watching that deal come to life after several years of the maze. And now there's a big, beautiful hotel and golf course there. That's memorable to me.
Love it. All right, so let's talk about, I mean, listen, the whole purpose of this series, as the intro says, is that there's, on the one hand, and you and I were talking about before we went on air, on the one hand, it's amazing in the RA space how this industry's matured, right? I mean, listen, in some ways, it's a very typical evolution and maturation. I've seen it in other industries where they're early on, there's not a lot of capital in this space. It's a disintegrated space, smaller players, whatever, and then it matures over time. Money comes into the space, aggregation starts to happen. We've certainly seen that over the last decade and certainly over the last 5 years, even more so. and you've made the jump from the custodial side onto the aggregator side. And really what we want to do is have this be a resource for folks to be able to understand the different models. So talk to us a little bit. I mean, because it's interesting, unlike some of the other CEOs that I've had on and will have on in this series, who have been there and built the firm and maybe started out as an RA firm and then started doing some acquisitions. You made a decision to jump into a particular platform, right? You're a well-known guy with a great background. I'm sure you had a lot of options. So what had you decide on Bluespring, and tell us what attracted you to it, which I'm sure is going to tell us something about what makes it attractive potentially to selling advisors who want to sell.
Yeah, sure. Well, Corey, I've been in the RIA space for probably 28 years at this point. And I got my start as a lawyer in the space. But as I like to say, I've been in the RIA space sort of playing in the nightclubs and bars before it was an overnight success. And I've said that before, but I really mean it's true. I mean, I helped a firm form itself back when the paper ADV existed, and you only had 25 million under management was the requirement to be an SEC registered advisor. And you didn't need any education. You didn't need any licenses. You didn't need any training. You didn't need any capital. You didn't need any insurance, and you could be off to the races. And if you were lucky, you had a client. So I've watched the profession evolve. Yep. And I think it is a noble profession. It's helping people, helping investors live better lives. And so having been in the space, and I was at Fidelity for 13 years, and I was really blessed to have a great career there and got to play my part in helping that platform grow. I was at a certain age where I wanted to try something, a new challenge. I wanted another mountain to climb, as my partner says, my partner at Bluespring, Stuart Silverman, and my business partner, I should say. So I looked around, and I looked at a lot of things, really, because, and it was, by the way, it was a very thoughtful process. And I decided I wanted to go to a place that was where there was there's a platform, and Bluespring has a platform, and it's a very optionality driven platform. And because it's a place where entrepreneurs can continue to be entrepreneurs, but a chance to continue to build upon it and add value. So I like the chance to be entrepreneurial and somewhat intrapreneurial at the same time. And I am always a big fan of telling people I mentor, telling advisors and advisory firms I work with, hey, be very clear on what your unfair advantage is. And I felt my unfair advantage is I had a pretty broad understanding of the space and some ideas on how I could help a firm grow. And there are a lot of great opportunities out there. And I arrived at Bluespring because I thought it was this, as I said, this undiscovered platform, a molded piece of clay with the chance to chisel more. And here it is. It's a 29 firm platform in 16 states and growing. The firm will do 9 acquisitions this year, and we've got lofty goals as we move forward, but not just acquisitions for acquisition's sake, to really solve the problems of our partner firms. And that's what we call them. And as I like to say, and I can go on, because I would like to give your listeners, your viewers, some thoughts on what their choices are, because we're not necessarily going to be the right choice for everyone. But I think for your audience, it's just good to know what the choices are. But we are, at our core, a practice management consultancy that just happens to be in the strategic M&A game.
Got it. All right. So that's a clear distinction. So let me take a step back and let's talk about like a very basic distinction that is somewhat very artificial, because I think different platforms have different aspects of this, right? But they talk about aggregators versus integrators, right? And like I said, if you look at every model, some of them are more on one end of the spectrum than the other, but often they have some elements of each, right? You talked about helping firms maintain their independence. So talk to us about the model, right? Where does it lean on the side? How integrated is it? The question is, do they keep their own brand? Is it one ADV? Do they have their own whatever? Do they have an equity play? Just give us the fundamental model before we delve in further.
Yeah, and if it's okay, let me just sort of lay out really quickly the choices, because that I think plays into what the model is.
Sure.
So if you look at the 15,000 SEC registered firms and the 21,000 state registered advisory firms, choice one, you don't have to do anything. You do nothing. Just keep on plowing forward as you exist and serving clients and hopefully fulfilled in your career. There's some issues with that. I'll come back to it. Choice two, and we see this a lot, some firms want to just de-risk a bit. Maybe they have a retiring partner and they need some capital, so you find a minority interest capital partner. It's not going to take control, but will provide some capital. Choice three, you find a pure capital partner. Maybe they buy more than 50%, and you have a capital partner that's not going to necessarily provide any other shared services, support, and so forth.
Yep.
Choice four is, and this happens to be our model, is we have the entrepreneurial model. We will take at a minimum a 51% interest in your firm, and we have a flexible deal structure how we do it, but we preserve the entrepreneurial model and provide a number of services to help propel the business forward. So you're not in it alone. You're part of something bigger than you are. I think choice five is, and you use the word integration, but you subsume into another brand. You lose your independent identity and you become part of a larger institution that is, I think, to use your words, an integrator, in that all you do for the most part is you continue to look after your clients. The firm will guide you as to new business activities, but then take off the entrepreneur's plate, perhaps all of the services that they need, whether it's planning, investment management, risk management, so forth and so on. Choice six, and this is the sort of the siren song, is you try to do an internal succession to a G2.
Yep.
And what we found in our research before we started Bluespring is a lot of founders would like that, and a lot of G2 practitioners, associates would like that. But the question was, where do I find the capital? Yep. G2s would say, I'd like to pay you out of cash flow, but the entrepreneur took the risk, and it's their cash flow that's ultimately funding that transition. So hence why, Corey, when we were talking, there's so much outside capital that's flowing into the space. And then I think choice seven is some combination of all of the above. It could be a crosstown merger where two big firms, or a regional merger, or you work with a partner that in a non-capital transaction where you outsource a lot. Our model tries to give the entrepreneur the best of all worlds. They get to keep their brand, they get to keep their client experience. We provide capital. We are looking for firms that are true ensembles that have G2 in place. Yep. And that word ensemble is very, very important to us. We're very deliberate in the firms that we want to partner with, but we take a number of things off of the firm's plate once we engage in a transaction and we partner with them. A lot of the things that we call the defensive tasks, like HR, benefits, financial reporting, financial implementation, if you will, procurement. And actually, this is one of the reasons that I was excited about Bluespring, a continuing enhancement of those services. So that's why I find it exciting. So sorry for the long-winded answer, but I do find that it's always important that anyone who's thinking about doing any type of transaction to know your choices. I know you feel the same way. So many of our friends, our colleagues have built these businesses. It's like their child. And you only have one chance in a real pristine way to engage in a transaction. So search is your friend.
Yeah, no, I love you laying that out, and really, that's so consistent with what we're trying to do here on this special series, is to have people understand all the choices and the differences. So let me delve into a couple more specifics so people can really understand it. So they're keeping their own branding. Is that in a DBA form? Do they have a separate entity? Is it one ADV? Give me a little more detail on that. Or give the audience a little more detail.
Yeah, the typical model, and I can explain the atypical one, is the name of the advisory firm, and it says a Bluespring Wealth Partner. So we have a firm that's part of our network called Capital Planning. They're based in Roseville, California. So Capital Planning, a Bluespring Wealth Partner, Jim Wilson and his team look after that firm, and they have their own ADV. And the same is true with a number of other firms on our platform. We do have a sister company called Kestra Financial, and some of the firms we bought sit on that chassis. So they have already been drafting off of the Kestra ADV. So it sort of depends on the model where they exist. But over half of the firms we work with are standalone RAAs. It's their ADV, it's their brand, and it just says that they're a Bluespring Wealth Partner.
All right, so listen, let's get into it, because we've already had on, and I'm pretty sure we're recording these. I'm not 100% sure which order I'm going to release them in, but I believe we will have at least had on at least one, if not more, of the more integrator models. People can listen, and we won't compare actual names to names, but we'll talk about models to models. And the pitch, right, that the more integrators say is, hey, yes, you're going to roll into our brand and some of our systems where we're going to take all this stuff off your plate that you don't want to do. You're going to be freed up, And the biggest value of having one brand is that we get to really increase enterprise value, right? Under one brand, under one integration. We work as a team. You're going to get equity in this brand. And so you'll get a big second bite of the apple when we're going to go at a much higher multiple, arguably than the aggregators who aren't integrated can. So that's, I mean, I'm oversimplifying it a bit, but that's their pitch. And listen, I say this not from a point of view of saying, hey, why are you better for everybody? Because you made the point, which I totally agree with, is that there's a reason why all these different models are out there and they could all be successful because different ones appeal to different people. So what's the pitch to say, no, for certain people, that's really not what you want to do. There's an advantage to having your separate ADV and your separate brand, and no, it's not going to maybe affect enterprise value difference as much. You tell me
Sure.
what's the pitch?
Yeah. And my answer is, I go back to something I said earlier. We're a practice management consultancy that happens to be in the M&A business. So we spend a lot of time with firm principals, partners, understanding what their motivation is and what's important to them. And we want to understand how they think about the client experience, how they think about the team and talent. And we believe that just like I think many do, that there's the transaction, but how do we also provide a deal structure where there is the creation of enterprise value and enterprise value in the future? So I think that many of the models out there, we're all aligned at that. It's not a let's do a transaction and then there's not any chance of upside. We think that that's part of the alignment, and that's, I think, something we've structured quite nicely. But Corey, I think that it starts with, we're practice management consultants. We want to know what's important to them. We think that there are various advantages to our model, that a lot of firms want to keep their own brand. They want to keep their own identity. They think it's vital to the client experience, but they want help and support. They want to be part of something bigger than themselves. And that's what we try to provide. And I think you said it nicely. It's not like one model is superior to another in the abstract. It's in the eyes of the beholder and the advisor. So that's where we try to be very consultative. And we're very culture driven. Everyone, I think, says that, and
Sure.
and many are, but we've done, I think, a nice job curating the culture within our Bluespring community.
Love it. So let's explore this, because you've mentioned it a couple of times. It's clearly a big part of your value proposition is this whole concept that you're practice management consultants, right? Acting as an aggregator. I want to give you an opportunity to explore that a little bit more about exactly what that means. So what is it that you can bring to these firms with that expertise and that focus that provides value beyond maybe what some others can do for them?
Yeah, I'd probably categorize it in three parts. One is, every time we talk to a firm that is considering a transaction, and we frankly decide not to go forward with at least 90% of the opportunities that we talk to.
Sure.
If it's not a fit for us, we're clear about why, but we want to help them as they think about how they're building enterprise value in their firm. So we provide the consulting irrespective of whether we're going to go to. Do they need to be more of an ensemble? Do they need to think about bringing in G2 or developing G2? Do they need to think about the way they're compensating, aligning, and motivating their talent? So our consulting starts before we even enter into any transaction, and in many cases at a point where we're not going to enter into a transaction. The second part is, if we are going to go forward, we take a consultative approach to how we're going to do business together and how we're going to structure the transaction so they're the right benefits, incentives, and horizon for not just the founders, but any G2 or G3 that they may have in the business. But then once you become part of our network, we have a business consulting group. And that includes marketing assessments. We have a large technology infrastructure that helps firms with their technology. We have a M&A team that can help with sub-acquisitions. And of course, we have access to capital. I don't know if I mentioned, but we are also backed by two private equity firms, a majority owned by Warburg Pincus, who's been a phenomenal partner, as well as we just brought on Oak Hill as a partner as well. So I think we have a lot of solutions. And then myself and Stuart Silverman and Harold Buckner, we have, I think, combined over 100 years of practice management experience.
I love it. So All right. So a question on that, right? You mentioned G2, you mentioned, and that's a concern that a lot of folks have, whether, and it can go one way or another. You have some of the firms that haven't done a good job, and the industry generally has not done a good job of bringing up the next generation. So you have some of these folks that don't have G2 in place, and one of the things they're actually looking for in a deal is a solution to that. And there's some of the other platforms that focus more on, hey, you can integrate, we have younger people. But then on the flip side, when they do have G2, which is a more attractive fit for you, for Bluespring Wealth, from what I gather, there's sometimes concerns in G2 about, hey, it's great, dad or senior partner or whoever it is, that you're going to get to take some chips off the table, monetize, and you move on. But we don't know whether it's the right time for us. We're early in our careers. Should we build more on our own? That comes up a lot, right? So how do you address, and listen, I mean, the focus on practice management and all the consulting you do is an obvious answer to that, but in more detail, like what makes you guys attractive to G2, and what objections do you hear from them that you guys can answer versus maybe some of the other platforms out there? Because I can't tell you how many clients where I have that, where we got to navigate the senior and the G2, and they have different interests and different timing potentially, and how do you make that work in a deal?
Yeah. So the main thing that I think is where we focused, and probably one of our unfair advantages, is we leaned in very, very heavily that we wanted to have a training program for G2s. So we partner with Philip Halavev, and I've known him for many years. He has something that we crafted together called the G2 Successor Academy, and we will offer that training. It's a 2-year program to our G2s that become part of our network. And it's really teaching them how to be leaders. So it's a simulated course, 2 years, where they meet with other peers. They have guest lecturers. You may have been a lecturer at some point, Corey, for all I know. There's a case study and capstone assignments. And that's really appealing because, sure, there's certifications like the CFP, the CPA, the CFA, JDs, but this is an apprentice-based business. And not everyone was trained to operate an advisory firm. So that's thing one. Thing two is, it depends on the arrangement that the G1 and G2 have put in place already. Some G2s have equity, others don't. Others have equity-like arrangements. And when at the point of transaction, it's a good time to sort of take fresh stock and align incentives. And actually doing a transaction can be a good point to actually share equity or synthetic equity, as the case may be. And then the third point, and I actually hear this a lot, is many G2s are really hungry and excited to be part of something larger than their firms. And that's what we offer here at Bluespring, the chance to be sort of part of something bigger than your own firm. And so that goes back to that notion of community that we discussed. So yeah, I think that actually is one of our stronger suits, our G2 emphasis.
That's great, because obviously, like I said, that comes up a lot. So in terms of, I think you mentioned that you've done, been 9 deals this past year or in the past 12 months, and the plan is to aggressively do more. Obviously, we've teased out a little bit or actually a decent amount probably in what you've talked about already. But if you had to talk about your ideal targets, your potential deal partners, what are the criteria for Bluespring?
Yeah, well, I've said a lot of it, but I'll go back to tape. It's probably 6 things. We like firms that are true ensembles. So it's not disparate practitioners, but they really operate in ensemble, a team fashion. Perhaps they're centers of excellence that support the teams, so the clients aren't single-threaded with one advisor.
So no surprise that you partnered with Phil Palaviv, because of course his whole thing is the ensemble practice, right?
Correct. Thing 2 is we talked about G2. We are looking for firms with strong G2 or developing into strong G2, and that's where we leverage the G2 Successor Academy.
Yep.
Thing 3, and this will come as no surprise, we like firms that are growing firms that have a culture of growth. But I'll add to that, when we think about firms that have a culture of growth, we like firms that have a plan and actually some pistons in place to power that growth. Yep. As most firms grow by client referrals. Some have COI referrals, but are they really intentional about it? The next thing that we're looking for is just clarity on what problem that they're trying to solve and how we can help them. So that's where I come back to that flexible deal structure. We always want to buy 51%. And as a floor, Corey, we're looking to partner with a firm that has at least 1 million in EBITDA, but our target is actually higher than that.
Sure.
But that's sort of one marker that we're looking for. And then I guess the other thing that I would share is firms that are willing to be part of a true partnership. We're in this together. And if we're going to grow enterprise value, that's the sort of mindset that our partners have to have. So we spend a lot of time getting to know one another and talking about how we'll operate. And so I actually think that one of our friends in comments said this. I said, I think there's a blue ocean here for Bluespring. There's a lot of opportunity. There's a lot of opportunity for all of us. And sort of that's the way we think about the world. And we've got some aggressive goals, not for growth's sakes alone, but really to bring the best solutions that we can to the advisory population.
Great. And so we talk about enterprise value, and we talk about the fact that, right, people are going to, the opportunity to build that. And part of the analysis that some of these advisors are doing at all levels, certainly G2 sometimes, is to say, hey, can I build my enterprise value quicker or slower than the enterprise, value that I'd be able to, even though I'm taking some chips off the table, right? If I've got an equity piece that's remaining in my firm or in the bigger firm, and you can clarify for that for us as well as to whether there's any equity piece in the bigger enterprise, what that part of the model is. But either way, some of the analysis is well, whose equity enterprise value is going to accelerate more quickly, and some of the attraction sometimes to join a bigger place is that you get the multiple arbitrage, right, and you can benefit from that. But that all depends upon when that's going to trigger and how that's going to trigger, right? So 2 questions: clarify the equity participation, and then 2, what is Bluespring's plan in terms of how they're going to realize that enterprise value? Are they going to go through multiple? Like some firms raise various rounds of VC capital, and in part, some people get the cash out. Obviously, we have some, not many, but examples of people going public, firms going public. So what's the monetization strategy, and how do advisors participate in that? What levels of equity, that kind of stuff?
Sure. And it's a great question. We have 3 tools in our toolkit when we're doing a transaction, maybe 4. I think they're 4. When we do a transaction, certainly there's a cash component.
Sure.
Second is the firm has the ability, depending on how we structure it, to retain some of their own legacy equity.
Yep.
The third, and this is our most precious equity, but one that we deploy regularly, is equity in our parent company.
Yep.
We're part of Kestra Holdings, and that equity is something that we use. We have and the ability to use, and I think that's a great example of giving firms the chance of upside. And then we also have another synthetic equity piece that we've fashioned, which is very popular. So as you said, it gives principals and G2s the chance at a second bite of the apple tied to the growth of the firm after an acquisition. So those are the 4 tools in our toolkit. And I will say that the equity in our holding company, our parent, has been very favorable. I'll give James Poor, our CEO of Kestra, a lot of credit. Kestra became an independent entity. Well, it spun out of another company in 2016. In 2019, Warburg Pincus became the majority owner of the company. And then just actually in August, right, just as I joined, it was announced that we were recapping with Oak Hill. Warburg is still the majority owner, but each time there's been a progressive realization of enterprise value. And I think that's the story. What the future holds, one can't be sure, but my strong suspicion is that we'll always be part of the private company ecosystem. And that's the thing. We're here to grow on behalf of our partners within the Kestra ecosystem, but of course our shareholders, all to the betterment of the clients that we serve.
Love it. All right. So I think the last general area, other than just anything else you may want to talk about, is just the bigger market, right? Trends and what things are looking like. So obviously we've had an amazing stretch. Our deal flow in the RIA space over the last few years has been ridiculous. And certainly the overall deals getting done in this space compared to what used to be the deal flow, the deal volume, and the money that's come in has been high. And I'll set it up. I think there's maybe you could argue some competing forces where you have this maturization trend where you would expect, just the way the industry is maturing and the natural growth of it, and the fact that we continue to have breakaways. So it's not, even though there's some consolidation, aggregation, there's like flow of new blood can continue to come in, which is great, which is why I happen to think the people who think this is going to get consolidated up very quickly and there's not going to be a lot of independence, or we got a long while before that's going to happen because we still have the movements to independence coming. But we also have some current or short-term headwinds, whether that's inflation or interest rates or the markets. Certainly, I mean, up until recently, I personally was able to say I haven't seen it affect my deals, but I just actually had one client who pulled back and said they told their banker, hey, listen, let's put it on pause. We want to see what happens in the markets. We've seen a little bit of, at least in deal structure, a little less on the front end, maybe pushing more to the earn out side. So it's starting this, at least I'm personally in the various deals we've done a lot of them, seeing some impact. What are you seeing out there generally in the marketplace, and how are you looking at the long-term trends versus maybe some of the short-term headwinds, that might be existing right now?
Yeah. And you just said it really well, long-term. If there's one thing I learned at Fidelity, and I take it to heart every day, is you have to think on the long term. And that's a company that I have a lot of admiration and respect for, that has always thought from a long-term perspective.
Yeah.
And I'll share with you a few things. One, I think this is a self-renewing ecosystem. If you look at my favorite report, and I urge everyone to read it, it's the Investment Advisor Snapshot that's prepared by the Investment Advisor Association, I think in partnership with National Regulatory Services. The RIA profession grew by 6.7% year over year. So the number of advisors grew. We're near like 15,000 registrants. And that's in comparison to other financial services regulated channels where there's actually compression in the number of registrants. Right. So it's a self-renewing ecosystem. It's not a maturing or dying ecosystem. A colleague of mine by the name of Joe Magner did some interesting work about ecosystems a few years ago and applied it to the RIA ecosystem. And we think it's one that continues to mature and grow. It's self-renewing. That's what I mean to say. Second thing is, beyond that, we are in this demographic age wave where people need solutions. So I think that there may be concentration, but I wouldn't call it consolidation. And I think that if you look at sort of the arc of what's happening in concentration in the RIA profession, it's still morning in the RIA profession. Yeah. It's morning in America. I'm not saying it's the crack of dawn, but we're late in the morning, or we're mid-morning. We haven't hit lunchtime yet. And by golly, we're nowhere near a siesta or dinner time. So we're either starting brunch or we're midway through brunch, but there's a lot of runway out there. And by the way, it's going to be fun to watch as things evolve, because we're also going through a generational transfer. So the baby boomers to Gen X, and then before Gen Y. So I think this is still a time of great vibrancy. If a friend or colleague asked me, would you recommend that their child go into the RIA profession or industry or ecosystem, I would give it an unqualified yes, for sure.
100%. And what have you seen though? So all right, so we're in alignment on the long term. What have you seen in terms of any impacts of some of the short term headwinds that we're seeing right now?
Well, markets go up, markets go down, but it comes back to my practice management statement. What's motivating, any potential seller? And I still think there's strength for those firms that fit all the characteristics and qualities that we were talking about.
Yeah, listen, I agree. And the interesting part is I've mentioned this on a few of the recent episodes, and I think it's just important for people to know. Like, I remember when they first started talked about the Feds pushing up interest rates, and I saw articles out there, not necessarily specifically in the RA space, but in the deal space in general, talking about, it's going to make cost of capital more expensive and it's going to cause deals to go down. Well, I anecdotally had a different experience over my 35 years of practice. And I actually did some research and determined that the research out there was consistent with my experience, which is that actually there's no correlation between higher interest rates and lower deal flow. Okay, there have been times when interest rates were in the teens and deal flow, like there's literally no correlation, all right, in terms of number of deals. And certainly we know, even if we are in a recession or going into the recession, which I don't like to talk about because I don't like to create self-fulfilling prophecies, but there are often more deals done in down markets than there are in up markets, because it just creates different opportunities. So yeah, I feel the same way. And I think there's also so much capital ready to be deployed in this space that it's going to take a while for that powder to go dry. So I think we're aligned.
Yeah, I mean, I would just say this to your listeners and viewers: don't read the headlines, read the chalk lines.
Yeah, love that. Love that. Okay. So listen, we can talk forever, but is there anything that I haven't covered in terms of anything you want to talk about or highlight about Bluespring or the industry, or you want to play us a song? What do you have before I go to my final two questions?
Well, I just want to say, Corey, I think we've covered a lot of ground. I really appreciate you having us on the show. It's been fun. It's been a great dialogue. And I just offer myself up. First and foremost, I think I'm a student of the profession. And if folks have questions, please reach out. I would love to play a little music because that's fun, but I'll follow your lead, my friend.
All right. All right. Well, I will. So let's see. How do I want to do this? Well, you mentioned people contacting you. So why don't you give what's the best place for people to find out more about Bluespring generally and to reach out to you?
Yeah, sure. You can go to our website, which is bluespringwealth, all one word.com, or you can reach me at david.canter, it's Canter at bluespringwealth.com. And heck, I'll even give my phone number, which is 650-388-6731. Please don't call me if you're trying to sell me extended auto warranty insurance, but I think I'm well covered. But otherwise, again, 650-388-6731.
Okay, so that's great. So I'm actually going to ask you my final question on the podcast, and why don't you answer that, and then I'd love you to play us out with anything you want to play us out with. Okay.
Yeah.
All right. So the final question is, and this I ask on every one of these podcasts, not just this special series. My highest value in life is freedom, and that means for me everything from freedom from all people in the world from oppression to the reason I've been an entrepreneur for decades and haven't had a boss. What does freedom mean to you, and how does it impact your life and business?
Well, I mean, I think you said some of it. I like the first part about freedom for everybody and freedom from any type of oppression. I think freedom for me is the power to bring out the best in other people and to hopefully associate and align myself with people that can do the same for me. I've reached a point in my life, my career, where the people I surround myself and align with and get to work with on a day-to-day means much more to me than any particular task. So whether it's my family, whether it's my colleagues that are my friends at work or business partners, it has to start with positive energy. And I do believe in the power of positive energy. And that's a great question. I'm glad you asked it. And I guess the other part of it is I've always been a great fan of the Grateful Dead. And it's right there in the name, by the way, gratitude. So I'm a big believer in humility and gratitude. So I don't know if those are embedded within freedom, but if you have the freedom to be humble and grateful, that's really important to me. And by the way, this is a real, this means a lot to me. This was an artifact that was given to me by someone you may know, a good friend of mine named John Hyland, who looks after a firm called Private Advisor Group. And I think he could teach us all a lot about freedom. So thank you for that question.
So for those people who are on audio only, describe what you just held up.
Yeah, so I have a Grateful Dead. It's sort of a coaster meets a motorcycle, and you have an Uncle Sam driving the motorcycle on top of a Steal Your Face base. And Steal Your Face is sort of the kind of iconic image of the Grateful Dead. And if you want more, call me or email me, and I'll show you more.
Awesome. So folks, listen, I think this is a great opportunity to hear David's approach of philosophy and Bluespring's unique offering and what makes them different from other folks. And I will tell you, I think the other thing that makes David different than anybody is I don't believe a single other RIA aggregator integrator leader is gonna play music for you during this series. So David, take us out with something, whatever you want to play.
Well, usually I would play a little Grateful Dead, but you might recognize this one. But instead, I'm gonna do, this is my favorite outro music. So why don't we agree on this, Corey, that I'll play this and you can just tell us when it's over. But okay. I don't have a pick, but this is one of my favorite songs by the Allman Brothers, and people might know this one.
Awesome.